You're watching Stock Watch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today, Roy Mutooni from Sanlam Investments and Drikus Combrinck from Capicraft. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. Roy, what's up with the PGMs? They are flying. Sibanye's up more than 11%. Valterra, the last time I checked, was also up almost 11%. All of them just trading in the green. What's happening?
It's actually quite difficult to put a finger on it, but they've been threatening to do this over the past few weeks. So you've seen the commodity price actually picking up, and then when you look at the resources complex, Platts had lagged for a long time, so maybe that's one of the things. And these things tend to be quite volatile. There's also a bit of a story around people substituting gold jewelry for platinum jewelry. I don't know how valid that is, but clearly at the margin, it's something that must be making a difference. So I think long-suffering shareholders are enjoying their time in the sun. It will be interesting to see if those PGM prices hold up above that 1,000 level sustainably, because that would put a bit of a fire under the stocks.
It's quite interesting because in this time that we have the PGM miners shares surging, we had diversified, mid-tier miner Jubilee Metals actually saying that they are selling their PGM operations and deciding to concentrate on copper. And I was like, I wonder if they're making a mistake at this time. But I don't know. It's just the thesis on PGMs not that clear where Drikus, where you'd be like, oh, this is a mistake.
Yeah, it might be. I'm not certain if they will go through with it. I know of a few shareholders that will vote against it. So it must be put to the vote, and so it's not a done deal.
Yeah.
I think it's a low offer. I think it undervalues the PGM business. But yeah, maybe the management sees a dire future for platinum. I don't. I think platinum will stay for us for quite a while. 50% of platinum demand is now non-catalytic converters. And the catalytic converters will be with us for some time. They're used in hybrid vehicles. Hybrids seems to hit the sweet spot when it comes to vehicle sales these days in your developed markets. So and hybrids still use catalytic converters. So I don't think it's going to go away anytime soon. The OEMs, your motor manufacturers, like Toyota, Volkswagen, etc. Those guys stocked up on palladium and platinum in 2022 when the Russia-Ukraine war hit, obviously because there's a supply problem that could have arose from Russia, and it was unnecessary. And they sat with a lot of stocks that had to be, wind down over the last 3 years. I think we're at that point. I think where fundamentally stockpiles have been wound down. We're in a big supply deficit, and I think there's a lot of upside for PGMs from what I think are very low levels compared to other base metals, basically other industrial metals, and definitely compared to gold.
Yeah, well, no doubt about it. PGMs are very polarizing at the moment, and people on either side think they're right. So, of course, this is something we will continue to dissect. We're talking about catalytic converters. There's a question on We Buy Cars. It's currently trading at 48 Rand. Would it go up from that, as it's probably like a monopoly here in South Africa? A monopoly, Roy?
Look, I think that's one way you could put it. I think what they've done is they've revolutionized how you deal in the used car market. So they'll buy anything so long as you can drive it in. So that gives you as a seller great comfort that you'll get liquidity, that there's value in your car. The selling side is where you've heard a lot of complaints and things, but the reality is they've consolidated that market incredibly well. They've got a national footprint and a big moat around it. Now, the question that you ask yourself is, does the valuation make sense? Clearly, they're growing aggressively. They were selling 13,000 vehicles a month a year ago. They're now on 16,000 vehicles a month. They think they can get to 22,000 vehicles a month by the year 2028, if I'm not mistaken. That is proper volume growth at a reasonable gross margin, and fantastic returns. So from that perspective, I think it's an investment well worth looking at. Clearly, there's a cyclicality built into here. Clearly, there's issues around how long they can hold inventory for and what the cost of that is. We'll only know that as the cycle unfurls. But for the time being, I like management, I like their razor-sharp focus, and I like the business model as it stands. The valuation is a bit stretched, but that's what happens when you get growth in an economy that's not growing.
Yeah. Drikus, would you be looking at this company at this point? I mean, Roy does mention that the valuation may be a little bit stretched, but would this be an attractive counter to you?
Yeah, I'm too much of a cheapskate.
So you want it cheaper, but if it were, is there a certain price that you would?
Yeah, sure. And a mid-teens price earnings ratio, I would reconsider. So I like growth stories when nobody else notices the growth story. That's excellent. But if everybody and his mother and his dog is already invested in the share, then I tend to stay away. I could be wrong for another few years, of course.
Yeah.
I won't stand in anybody's way buying We Buy Cars. I think it's a great business. I just think that they will hit a bump or two somewhere along the road. No pun intended.
I mean, it's quite interesting because even that target is very ambitious. But I mean, as Roy points out, that they look like they are well on their way. So we will see if that target doesn't indeed get clocked in the next 3 years. Well, let's go into the broader markets. Can you ask the panel which is better, both or one of the two ETFs? Stocks 50 or S&P 500, and then the viewer says Europe looks good. So I guess here it's US or Europe, Roy.
So the thing is, we all know the S&P, the base valuations are very stretched. Money's been going into the US since COVID very aggressively, and those valuations are quite stretched. Europe was quite ignored, but remember, it started to rally already. I mean, Rheinmetall, which is one of the big stocks there, has moved.
Yeah.
LV, all of those stocks have started moving. On a relative basis, there's still a big gap, and on a relative basis, you're probably better off looking at Europe, but I don't think it's still as dirt cheap as it was before Liberation Day, before Trump's time. So you have to consider it that way. I think there's value in stocks. There's overvaluation in the US. How long it will take to correct is anybody's guess. Maybe we're already on the way there.
Your take on the Euro Stocks 50 versus S&P 500, Drikus?
Yeah, I'd actually go for Euro Stocks 50 at this stage. I think there's a big fiscal spending coming in Europe over the next few years. They've got more leeway to do so. I think the US is also going to spend, but there is a battle within the Trump administration, within the Republican Party, and they might constrain, the US fiscal budget fiscally. So I'm not sure how much spending there's going to be. So a bit of austerity in the US would actually be negative for stocks. Too much fiscal spending drives up the 10-year yield, and then long duration assets like all your growth stocks will suffer as well. Europe doesn't have those two problems. They're quite attractively valued. Outside some of the defense companies, some of those shares have barely moved. And sit, you could easily fund low teens, high single-digit price earnings ratios for multinational businesses. Obviously, tariffs is the issue, but if the tariff war does pick up speed going forward, it will also affect the technology companies. It will not only include goods but services as well, especially for the tech companies. They're going to be increasingly under scrutiny, especially in Europe, when it comes to the avoidance of tax or the little tax that they do pay. So I just think the composition and the price levels of the S&P 500 makes me weary of staying there. And I think there's upside to the euro stocks if the fiscal package comes through, or if some more populist right-wing parties take over, then they will dump the destructive energy policies that's been running in the likes of Germany for 20 years. That'll be a big positive for the euro area. And if Ukraine waves the white flag for some reason tomorrow, then the one place that you want to be invested in is Europe. So there's always that outlier, but the biggest thing is it's much cheaper, and there's a lot of money coming their way.
Well, talking about cheap, let's get into cheap retail, Pepkor. Although I don't know how, fine, they have affordable clothing retail side, but also I feel like they're also now moving to more higher end clothing. And I feel like the story is kind of evolved because a lot of people have been talking about their fintech side as well. What's the story with Pepkor, Roy?
So I think that there's a couple of legs to this. So there's the restructuring at Ackermans and the cheap end of that. Then there's Flash Mobile, which has been growing aggressively. They are apparently the biggest retailer of cell phones in the country. And then there's the Brazilian venture as well. I think when you put them all together, you get quite a good growth base there that attacks the consumer at the entry level, nicely diversified there. And then the prepaid market, where people want affordable phones, they want facilities for these phones, they're willing to buy airtime and all of that. And then there's a possibility that they could actually get Brazil right. So you put all of that together, relative to the valuation, I think you have a pretty neat and tidy medium to longer term growth story that's developing there.
Just quickly, your take on Pepkor and I guess the thesis that you're seeing, if you do have that on your radar, Drikus.
I think Pep is one of the best long-term growth track records on the JSE. It's still growing, decent return on investment levels. We don't own it currently, but I won't stand in anybody's way once again if they decide to buy tomorrow. And if the conditions warrant it, we might be buyers ourselves.
All right. More questions coming your way. Let me get to Aspen. All right, and of course we know that Aspen has been one that a lot of people have been asking about. Noted that was 2 days ago that Allan Gray upped their holding in Aspen. I am sure that an asset manager of Allan Gray's quality has done their research into the contract issues at Aspen. Why should I not follow Allan Gray, Drikus?
Because Allan Gray's record the last 10 years is not that great. Sorry, Allan Gray. It's they've got brilliant billboards. I love the billboards, but the track record is not that great. It's not bad either, and there's a lot of other opportunities out there. Having said that, Aspen is not a bad pick. I think that they get deleverage, the balance sheet through asset disposals. Maybe they've sold a few stuff that's actually part of the family silverware, but and the manufacturing side is starting to scale up. It's emerging market company. So if emerging markets pick up, they will pick up as well. Emerging market pharmaceutical. So they're in Latin America, they're most of Sub-Saharan Africa and in Asia. And if they, if emerging markets pick up, and once again, knowing Allan Gray, they like emerging markets, so do I, so I'm with them there. And if emerging markets pick up, and I do think for different reasons that they will, not only will there be margin growth, from a deleverage income and statement and obviously asset side, but I do think that they will re-rate as well. They're not expensive at the moment. I think they're sitting low teens price earnings level.
Okay, quite an interesting take that you have there, that a high tide will basically lift all boats, including Aspen. Roy, on your side, the viewer says, FYI, I already own Aspen shares from before the price drop, so clearly experienced a lot of pain. Does this change the answer to the first part of my question? Yeah, if you already taken the pain,
No.
and Alan Gray is adding, I don't know, would you feel like you need to add more?
No. I think the first thing is, first, I think it's very important to do your own research. You've got no idea why Alan Gray are buying.
Yeah.
Absolutely. They've got a great reputation, track record or whatever, but it's your money that you're putting to bed. So you need to be comfortable about what you're buying. That's step one. I mean, Drikus and I can come with our recommendations and things, but at the end of the day, you have to decide what works for you. And then the second thing is, I think the thing about Aspen is that they've disappointed on a number of occasions by not delivering. The big angle that they've had in the past 1 or 2 years is they've had the sterile capacity, which they've believed has been in great demand globally, and they believe they would get some good contracts to come in and fill it, and operational leverage, and we're off to the races. And that actually hasn't happened. And I think that's where the disappointment has come. It isn't so much the contracts or anything. It's just that since COVID, well, first it was the vaccines, and a variety of missteps that have happened just mean that the market just decided at this point in time, enough, let's step aside and see what these guys can do. And I think that's the issue. So to the investor, I think the next rand you invest has nothing to do with the old rands you invested. Make a decision today as if it is on a white paper. Don't say I'm averaging down. This isn't an ETF or a fund. This is a stock. Decide right now which is the best stock for my aspirations and for my investment goals that I can go into now. Maybe it's Aspen. Most likely it's something else. I think it's important to be that open-minded.
All right. Well, let's go into insurance. Gents, OUTsurance. Can investors get something out here, Drikus?
It's a strong business. Underwriting margins, excellent. They're expanding into new, adjacent markets. There's not a lot that I don't like. ROEs, above 20%. It's a good business. It's not cheap. Maybe it's just to sleep it, just put it in your portfolio and forget about it. It's what I've said is already priced in as well.
Okay.
So I'm not excited about the price, but I'm not going to force you to sell it.
Okay. All right. Yeah. And this really has found favor with investors for the last while. I guess then it explains why it's not cheap. Roy, what would you be doing with OUTsurance?
Well, the thing is, it's not often that you find a short-term insurer that actually has underwriting margins. Most of them make underwriting losses, make it up on the investments and on the float and everything. So, like Drikus says, this is a solid, well-run business that is dominating its markets and continues to grow. A lot of it is in the price. If you went in right now, you're betting that this innovation can continue to expand and you'd get paid for it. I would say it's a long-term bet right now. The easy money is probably being made. Maybe this is one of those ones that you wait for something to go wrong in the market and the whole market sells off and you get in when it's much cheaper. Maybe that's the way to think of it, or just buy it as a fair, good quality stock that you can hold for the long term.
All right. Let's go into more financial services. Alex Forbes. What is behind Alex Forbes' strong performance over the last year or so? Does it still offer value? Drikus.
Yeah, I'm not too sure about the thesis on Alexander Forbes. I was under the impression there's other financial services company that's trying to buy them out from the JSE. So I've been and that's basically priced into the share price. So I haven't kept my eye on the ball there. I know there's been some strategic realignment
Yeah.
recently, but no,
Okay.
I'll pass on this one.
Okay. Roy, your take on Alex Forbes and the momentum
So,
we've seen recently.
so you've seen with everything that happened with Two-Pot and people needing advisors and restructurings of pensions and all of that. I think they've been a big winner from that world. That people have needed more advice, that that people have needed the consultants a whole lot more, and they've won a whole lot of business right there. So I think from an operating perspective, that's what's really carried them. Remember as well, it's very liquid. There's some big shareholders there, so little news tends to move that share price quite aggressively. Like Drikus said, there's probably also some corporate interest as well that's underpinned that share price. So a combination of liquidity, solid operational outlook from Two-Pot, and the need for more advice and the need for consolidation among pension funds, and the potential of corporate action there, I think, is what has driven it.
Okay. Well, let's get into Telkom. Roy, I do know that that is your stock pick. So, Drikus, your take on Telkom before we go into the stock picks. View on Telkom on a 12-month view. That's also been one that's performed quite well recently.
Yeah, regularly I look at Telkom's balance sheet and I think, wow, there's a lot of assets there just sitting and doing nothing. It's trading at a fraction of book value. If they can only do something, if they can only sweat those assets, but a lot of those assets I think are actually not worth much. They've been underperforming on the assets, but it looks like things are changing a bit. It looks like, the next generation products, are coming through for them. They've completed the divestiture from what's it, SwiftNet or something,
Yeah.
and there is some subscriber growth. Yeah, I think it's 20 odd million these days, double-digit growth. So maybe there's something happening. I've been bitten before by Telkom. I bought it as an asset play, thinking that somebody might come out and strip the assets. That was stupid. Never happened. But maybe there's some operational performance coming through. I would really like to hear what your thoughts are.
Yeah. Well, let's get to that stock pick. Roy, your thesis on Telkom.
So Drikus, you were right. There was a time when this was an asset strip story. So there was SwiftNet, which had value, and we saw that when it was bought out, and the fiber business as well, which we all thought MTN was going to buy. But
Yeah.
what effectively happened was, rather than it being stripped, they kept the fiber business. They sold SwiftNet. What SwiftNet helped them do was pay down their debt, and their mobile business suddenly made sense. Why?
Okay.
Because on the prepaid side, they became the preeminent data provider. So they're much cheaper than the other guys. So the guys can't cut prices to compete with Telkom. Because remember, they've got 2G and 3G customers. Telkom doesn't have those. They've got their 3G, they've got their 4G customers. Their network is 100% 4G. So they've sold themselves as cheap data out there, and the big guys can't catch up with them. That's why you've seen service revenue growth in the mid-teens, whereas the big guys are in the mid-single digits. That is a sustainable competitive advantage until those guys migrate all of their 2G and 3G customers onto their big networks. So I think for the time being, over the next 12 to 18 months, it's very durable, it's very sustainable. I like management. They're focused now. They're not empire builders. They're just delivering on operational value. And the valuation is not demanding, even after this rally.
Okay, nice. Well, let's get to your stock pick for today, Drikus. What are you choosing?
It's a UK-listed asset manager. They manage emerging market equities, but more debt than equities. So emerging market credit, basically. If you don't know, emerging market credit yields quite a bit more than developed market credit. I think developed market credit is overvalued, especially that in the US. I think there's a bit of a credit or private credit bubble, at least in the US, and the corporate bond markets, investment grade bonds, two junk bonds, everything is. I think it's it's over. There's a bit of a, I would call it a bubble, but it's expensive. So with the dollar that's been in retreat and money flowing back into other parts of the world, and obviously emerging market currencies doing quite well, I think that the focus will shift towards other geographies, other asset classes maybe. I think emerging market credit looks quite attractive. And if you're buying Ashmore, which is one of the largest managers of those in the developed world, and listed, you're buying it for song basically. It's sitting at a 10% plus dividend yield, high teens price earnings ratio, and it's basically an ungeared business.
All right. Well, thank you so much for those interesting insights, gentlemen. Really appreciate your analysis today. And that is all for tonight's Stock Watch. Thanks to our guest, Roy Mutooni from Sanlam Investments and Drikus Combrinck from Capicraft. Be sure to tune in on Tuesday at 5 p.m. as we'll be bringing you the JSE Stock Picks event. That's where South Africa's top market watchers will be giving you their best stock picking tips right here on Business Day TV. Up next, though, the close. Stay watching.